Welcome to Integrated Insights with ICCG. For more than 30 years, our team has partnered with small business owners to prepare for and navigate the business transaction process. Pull up a chair as we share stories and insights from our experience on all sides of the M&A table.
Welcome back to another episode of Integrated Insights. Today I've got Dave Parker and Grant McQuilkin. How are y'all doing?
Doing good.
We're good. Mason, how are you?
Hey, I'm doing great.
Are you doing great?
I'm doing so good.
That's good.
Gosh.
You're going to have a baby pretty soon.
I am going to have a baby pretty soon.
Oh, you and your wife are going to have a baby pretty soon.
Yeah.
That's cool.
Yeah, she's the real hero, so it's good. So today we're going to be talking about real estate within a business transaction, just kind of what that looks like. And so one of the questions that we get from business owners all the time is, should I lease it or should I sell the real estate?
That's a great question. I'm going to let Grant deal with that because so much has to do with tax stuff, right? So, but it really depends on the deal. I mean, it depends on what they want, right? Which is always important. But the structure, we just recently closed a deal that the sellers decided to hang on to the real estate, but they also plan to sell it in the future. So there were some things done for that planning. In another case, I know we've held off a seller who's wanting to sell the real estate because of some tax consequences that Grant can explain. So, I mean, wouldn't those two things really matter the most, Grant?
Yeah. The overall financial goals of the seller, typically, if we're representing a retiring sort of guy or lady, then it really does matter the overall financial picture, right? Dave, you and I chose to keep some real estate in the businesses that we sold because it accomplishes a diversification of our own portfolio. So, I mean, it just depends on the goals. That's why you have to go back to sitting down with advisors who are wanting to really help you figure out what those goals are and then help you accomplish them. But I think, sometimes, Dave, you and I have been in businesses where the real estate is really key to the business, right? If they have a license attached to it. Some of our businesses in the old days were licensed storage facilities. And so it's just hard to separate that out. And if you do, then a buyer will want a longer term lease so he doesn't lose those licenses, right? And so it's not just a decision by the buyer on whether he wants to keep it or whether he wants to sell it. It's also the buyer has to make a decision as well. Yeah.
And that also increases value in that business if it's going to continue to be used for that purpose, because in that particular case, you can't find those licenses. You can't find land that will allow those licenses.
Right. Zoning has something to do with that as well. Sometimes businesses, the zoning is very rare in the city, and to like body shops, for example, cities don't want necessarily paint booths in certain neighborhoods or near certain real estate. And so the value of a secure position in that real estate by a buyer is very important because he doesn't have to go apply for zoning in an area that doesn't allow it.
And then through the years, you and I have talked about, should we sell that piece of property? Should we not? And it's something we revisit quite often. It's always based on return, right? Pretty much. But, through the years, we've picked it up at a good price because of an option we held when we bought the business, and when we sold it, we kept it.
Yeah, because it's such a predictable, particularly on the leases that we hold, on the buildings that we own, Dave, we have triple net leases, so we don't really worry about it. We pick up a rent check. They have to pay for insurance, taxes, and repairs and maintenance and those kinds of things. And so it's a great investment that yields a steady retirement income. If Mason would just get his butt in gear, then maybe we will be able to retire, Well,
let's talk about that instead of real estate for a while.
Yeah. Okay.
Should we go ahead and do Mason's review now?
That's exactly right.
Let's do all of our reviews on the podcast episodes.
We'll do that on the next. We'll do that. Yeah, let's do all the employee reviews, Michael and Andrew and Mason, all in the next series of podcasts.
There you go.
Yeah.
There you go.
Pick up the listeners.
I know. We'll go number one on the charts for sure. So, what are some of the potential tax implications when you are buying the real estate or selling the real estate and lease versus leasing it out?
Yeah, obviously when you lease real estate, you're going to get to deduct the rent payment. When you sell real estate, it will result in taxes. And so typically a business is not housed on raw land. And so it's a building that you've depreciated. And when you have depreciated assets that are sold, whenever you recoup that amount that you've expensed, it's ordinary income and it's due the day you sell it. It's not something that you can put off with a payment or something like that. And so you have to consider the taxes that are due. And if you sell the property and your business in the same year, you're likely paying the highest tax rate possible on that depreciation recovery. And so you just need to plan it out and make sure that you're considering a huge tax bill.
Yeah. How do financing considerations differ when it's leased versus owned in a business transaction?
Yeah, when banks will tell you they lend on cash flow, but it's not really what they lend on. I mean, they lend on cash flow formula wise, but they want collateral. And so a buyer sometimes, especially in your smaller transactions, a buyer needs the property so that he can get a huge amount financed. It's just easy for the banks to collateralize real property. In larger transactions that we typically deal with, a buyer that maybe is a private equity group, they typically don't want to spend capital on real estate unless they have that in their portfolio, but generally they don't. They want to come in and buy the business and lease the property from the owner. But that's because they have collateral in other businesses that they own that will help them leverage more of the cash flow that the business produces. So the only time that it affects that transaction is the larger the rent that you require the PE group to pay, the less cash flow they have in order to finance. And so they're not going to pay as much. So you have to know whether you need to raise the rent or whether you need to decrease the rent in order to get the most out of a sale of a business.
Well, and oftentimes if a business owners own that piece of property, they may have inflated their rent. I mean, this is just kind of one of those things that people do. They inflate their own rent so that they're taking more out of the company, right? Which then that could bite them in a sale because they're expecting that increased rent, which may be above market value. I won't say inflate, I'll just say above market value rent. And so it'll happen just like you said, Grant. It'll affect the sale price, and someone has to say, well, if they're going to sell the business in a couple of years, it may be worth it because it's going to be a factor of the multiple at that point, right? How it affects the price.
Yeah. Thinking about the conversation Grant was having the other day with a client of ours, and just kind of explaining to him, the rent that his agent was telling us about was, increased rent price, which was going to affect the valuation of the business if that's what we were having to, the expected buyer was going to have to pay. So touching on that, but that's good. So if I'm a buyer, how would you structure the transaction differently than just a regular business purchase? Yeah,
this is a question that I wish buyers would ask their advisors when they go out and buy a business, because we face now two in the last year. Mason, you and I specifically have faced two where we've had C corporations have appreciated property inside of the C corp, which is just really hard because it produces, no capital gain income. It's all ordinary income, and it's double taxed because it's inside of a C corp. And so the first thing I would tell a buyer, do not buy the real estate inside of the same entity, specifically not a C corporation entity, and keep it separate and lease it to the business. That would be, and make sure that entities like an LLC or some sort of pass-through entity, and it's just so much easier, so much cleaner. And even in a situation where you're actually buying the real estate and the business, even with an SBA loan, we've seen it possible where you can separate that out into a separate entity. So for sure, structure it that way.
Yeah, that's great. Well, I think that's all we have for this episode. We'll pick back up in our next episode with more real estate considerations.
And that wraps up another episode of Integrated Insights with ICCG. Be sure to subscribe and stay tuned for more stories from our team. We love hearing from our listeners. If you have any questions or topics you'd like us to cover, please send us an email in the show notes. For more information about ICCG, please check us out on our website or follow us on LinkedIn and YouTube. Until next time, there's always a seat at our table.